Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So this is going to be a Q&A video. I'm going to be taking questions from the previous Q&A video that we did in December, and I'm also going to be taking some questions from what was asked in the community tab over the last few days. So if you've got your own questions that you want to be answered in the next Q&A video, drop them in the comments down below. Only caveat to that is please don't ask for stock tips or buy and sell recommendations or anything like that. But outside of that, pretty much anything I will answer. So feel free to drop any questions below. So let's go ahead and get right into it. First question is from Greg Gates. Can you please explain? I added that section in actually. Can you please explain? Explain PE ratios and things you use to loosely value a stock, or using Yahoo Finance to check performance. Show an example of what graph you look through in the past and current results, etc. I'm totally new to investing, so thanks for letting me know about Hatch. I didn't want to invest in American companies on some risky platform. Okay, thank you for the WeGem of info. All right, so on PE ratios, basically, I think they are a useful starting point for initially screening out a lot of investments, although they should definitely not be the only thing you look for when valuing a company. A good rule of thumb I like to use is that a roughly fair value, again, lots of caveats to this, but a roughly fair value guideline that I like to use for any given stock is that it should be trading sort of in and around double the growth rate. So if a company is growing at 20% a year, it's probably worth somewhere around 40 times earnings. That's, again, very rough guideline, but it's a thing that I use to screen a lot of ideas out. So if I find something that's growing at 10% a year and trading at 40 times earnings, I'm pretty much just going to throw it out straight away and carry on. If I find something that's trading at 15 times earnings and has grown at 20+% a year, I'm going to look very closely at that. So there's debt levels and several other things that kind of come into that equation, but that's kind of a rough rule of thumb I use. As far as graphs, I typically look at the earnings history and just to kind of get a feel for what the earnings and revenue growth or lack of growth has looked like over the past several years from Yahoo Finance as well. So I'll put up a screenshot of what that looks like here. But that's really about it for, you know, what I get off Yahoo Finance and how I sort of basically use PE ratios. So that's the first question from Greg. Next question is from Susie Reed. What's your opinion on a house you live in being a liability, not an asset? Do you think that the first property you should buy should be an investment property or a personal property? This is something I have been putting a lot of thought into over the last couple of years. I'm not a homeowner, but my partner and I have probably had the ability to get into that for a couple of years now. So I'm not currently a property owner. I do actually largely agree with the whole the home you live in is not an asset, it's a liability because it's creating a lot of negative cash flow for you. So this question's so personal. Like, I think if you're someone like myself who has very few financial responsibilities, I don't have kids or anything like that, you know, I don't think you need to own a 4-bedroom home and be paying like $800 a fortnight on a mortgage or anything like that. So find a cheap rental, live like a student, and save a bucket load of money. That's basically been my strategy. I'll buy a house at some point. I would like it to be, I'd probably like to do some sort of house hacking or something like that. But who knows, there may be other small versions of Tom running around by that point, and that might not be possible. But I basically agree with the Robert Kiyosaki way of thinking that your home is a liability rather than an asset. I would love to get into the rental property game. I like the fact that you can use leverage, relatively consistent cash returns, all those sorts of things, which you can find in businesses, but I really like the fact that you can kind of use a little bit of leverage relatively safely in real estate. The issue with New Zealand real estate, in my personal opinion here, is that prices are just sky high and you're getting like 4-5% rental income yields before you pay rates or repairs or anything like that. So prices, in my opinion at least, are quite high at the moment. So not something I've gotten into, but those are basically my thoughts. Little Tuna Fish, great YouTube name. Thanks, Tom. I've got a question about cash allocation priority. if I have a reasonable amount of cash to pay off most of my home loan, should I do this first and be debt-free early, or should I invest in ETFs and pay it into the future? Just start investing, so it's unrealistic to think that I can multiply my cash like Pabrai did, unfortunately. So ETFs are what I'm thinking about right now. And the interesting thing with Monish Pabrai is he is actually completely debt-free. That's kind of the first thing he did when he first got a lot of money from kind of selling a portion of his business, is he got debt-free. So if you want to be a modern Monish Pabrai, maybe that is still the best thing to do. Again, I'm not in your position because I don't have a mortgage or anything like that. Again, that's sort of a personal decision, but the way I would personally think about that is any dollar you put towards paying down debt, the interest rate that you're paying on that is essentially the sort of instant return that you're making. So if you've got credit card debt where you're paying north of 20% a year, pay that sucker off, because you're going to have to, if you put that to work in stocks, you're going to have to generate greater than 20% a year to do just as well as if you had paid off that credit card debt. So that's the way to think about it with a mortgage as well. If you've got a 5% interest rate on a mortgage, putting a dollar towards that is essentially like locking in a 5% return had you kept the mortgage and put that money elsewhere. So I don't really have an opinion either way, but that's the way I would at least think about it. Next question is from Shannon Hudson. Hey Tom, do you have market ethics? I was wondering, and it would be a good idea for a video. Thank you, Shannon. For instance, Z is low, but I wouldn't touch it because it's an oil company. What do you think about this? A lot of the people I follow, especially the kind of Phil and Danielle Town kind of way of thinking, is that you should kind of vote with your money in terms of buying companies that you want to support and those sorts of things. To be honest, I can see where they're coming from. I don't tend to agree with that quite as much, to be honest, and it kind of falls into two different camps here. So actually Warren Buffett has probably pretty similar ways of thinking about this as what I'm about to say. So with Buffett, for example, he would basically never touch a company that he doesn't fully support ethically, in terms of buying that to be a fully owned subsidiary within Berkshire Hathaway. So he would never go out and buy an entire tobacco company, for example. But he's more than happy to own the equity publicly in that tobacco company. So that's sort of the way I think about it. I mean, at the end of the day, someone has to own all the shares, whether that's me or a pension fund or whatever else. At the end of the day, someone's got to own all the shares. So I don't really buy that argument quite as much as a lot of people do, that you should vote with your money. At the end of the day, the only way that companies can benefit from you sort of voting with your money, if we do have a whole crowd of people that funnel into one given stock and that pushes the stock higher, the only way they can really benefit from that is issuing more shares and diluting your shareholding. So yeah, I don't know. It's again your call. Personally, I'm not quite as on board with it as many other people, but you know, as it stands so far, that's never something that's stopped me making an investment. That said, I've never really invested in a company where ethics, I think, might be questionable. So that is my thoughts on that one. And that's all the questions from the previous Q&A video. So let's get into the community tab question.
Hey everyone, video editor Tom here again. I seem to be making a habit of this in the Q&A videos, but I did miss two questions. So Liv asked, when am I going to be playing for the Chiefs? That'll never happen. Second question that I missed was from Luis, and I'll put up a screenshot of it here. Luis was asking, as a small investor, does it really matter what price we pay if the business is good enough? If we just keep buying it over the long term, does price even matter, basically? So the short answer is yes, it does. So a really good extreme example of this, just to kind of prove a point, is Microsoft. So if we look at the stock chart for Microsoft and we assume that we bought shares in Microsoft in the dot-com bubble, thinking, you know, dot-com stocks are amazing, the internet's going to take over the world, this business is so good it doesn't matter what price I pay, it's all going to work out, you would have basically got no return besides dividends up until I think about 2013. I'll put it on the screen here so you can see exactly how long that took. And throughout that period of time, Microsoft was performing reasonably well. It was generating a lot of cash. It wasn't like a lot of dot-coms that just sort of IPO'd and then went nowhere. It was producing real cash flows for a long period of time, but you basically made no return because you paid too much for the business up front. So short answer is yes, price does matter. If you dollar cost average into a good business that's trading at least a reasonable valuation, you're probably going to be okay. But if you get into buying things at extremes like Microsoft here, for example, it can work out quite poorly. So thanks for that question. Let's get on to the rest of them.
So Luis, what is the first thing you would buy once you're filthy rich? So I've actually been thinking about this over the last couple of days because I saw this question when it was first posted by Luis a couple of days ago. I think if a multi-$100,000 purchase ever got to the point where it was just a rounding error on my net worth, I would probably buy a massive, well, not massive, a fully kitted out boat. I've always been relatively into fishing, probably more and more so over the last couple of years. So I'd probably buy a $300,000 or $400,000 fishing boat would be awesome. So that's probably at the top of my list. I probably also wouldn't skimp so much on buying pay-per-view like UFC fights and that kind of stuff for entertainment purposes. So those are probably the things at the top of my list. But I really I'm not the kind of person that has aspirations to own like 10 supercars or anything crazy like that. The reason I invest more than anything is to try and get freedom, basically. I want to be able to go and do whatever I want to do, whenever I feel like it, basically. So that's really my motivation behind trying to grow my wealth and that sort of thing. I'm not looking to live an extravagant lifestyle. I'm perfectly fine living a relatively humble life as long as I've got freedom in there. So thanks for your question. Question from Henry Michael. Hi Tom, we've been warned of the next major share market correction for the past year or so based on certain indicators being at record high levels. Do you consider taking profits and selling out of a stock and waiting until the correction before bagging a bargain, or do nothing? We're aware that Mr. Buffett is sitting on a treasure chest of cash. He certainly is. So my approach to investing in any market, regardless of whether it's high or low or whatever, I'm a person that likes to select individual businesses for investment, so that's what I do. I don't look at the market. I look at individual companies. If they're offered to me at what I believe to be a large discount, I'll purchase them. If the prices get stupidly high and I've got somewhere else to put the money, I will sell that and put that somewhere else. So that's basically my approach, and that really never changes with where I think we're at in like an overall market cycle. I don't think anyone can predict that. And that's the reason that Warren Buffett has got so much cash. I don't believe he's making some sort of macro bet on the stock market crashing or us having a recession or crazy things happening with interest rates or anything like that. I think he's purely looking at individual opportunities one at a time, and he just hasn't been able to find anything for quite a while. He hasn't been selling shares in businesses at massive scale to build that cash pile. It's been coming from the operating businesses that Berkshire Hathaway owns. So that is my thoughts. Mosuf Khan, would you like to invest in Indian companies in the near future? I have no discrimination against any country for investment, basically. So I will invest almost anywhere. Probably the only caveat to that is countries that have major like currency issues and stuff, like Argentina is one that comes to mind. But I'd basically invest anywhere. My preference would be to find companies in New Zealand and Australia would probably be my absolute perfect world scenario for investment, just because we have slightly better tax treatment, particularly in New Zealand with the treatment of taxation on dividends and so on. So that would be my preference, but I would really invest anywhere where I can find a good deal. So those are my thoughts there. Norabu, what are your thoughts on the interest rate cut as well as interest rates in the US potentially going to zero, hopefully not negative? What impact could that have on American financials or internationals if they are tied to the US in some material way, especially since we have seen what negative interest rates have done to massive banks outside of the US, such as Deutsche Bank and HSBC. So I don't really have any special insights on how this affects the banking industry. I know the basics of what a bank does, but I really don't know that model inside out to the point where I'd be comfortable making an investment. So I can't really give you a great opinion there. What I can say is negative interest rates or interest rates generally affect asset prices dramatically. So if interest rates are very high, all other asset classes that are quote unquote riskier will generally be valued at a lower level. And the reason for that is basically, there's less incentive for you to get away from those sort of risk-free assets like the US Treasury bills and get into riskier assets like stocks or real estate. If you're getting paid a really high interest rate. So if you're getting paid 10% a year on your savings account, stocks are going to have to look very cheap and very attractive for you to sacrifice that guaranteed 10% a year to go and put that into stocks where you might generate more than that. So on the other hand, if interest rates are very low, like 1% or something like we're seeing at the moment, stocks have to be extremely expensive before you would think about not investing in stocks. So interest rates are like kind of gravity on asset prices, and the same holds true for when they go negative. So I heard a Charlie Munger quote that if anyone tells you they understand negative interest rates, then they don't know what they're talking about. But essentially the way I think about it and the way I've heard Buffett talk about it is going from a 1% to a negative 1% interest rate is largely the same in terms of how it should affect the prices of other assets as a drop from, say, 3% to 1%. So same incremental kind of decrease. So those are my thoughts. I hope interest rates don't go negative. It's very unhealthy for the economy generally. Makes me feel really sorry for the people that are in retirement and those sorts of things that don't want to take a lot of risk but still need money to live. So I hope we don't get there. But I certainly wouldn't rule it out with the way things have gone the last decade. So thank you for your question. Next question is from Sam Smith. Hi Tom, been wondering how value investing has worked out for you this far. Is it worth time and effort, or had it been better to just buy into a market ETF each month? Thanks. This is a really good question, and it's one that I do certainly put some thought into. The last thing you want to do is spend hours and hours and years of your investing life doing something that's not going to generate a good return versus had you just indexed to the market. And the short answer to this question is that it's probably too soon for me to give you a reasonable answer on that. So I've been investing about 3 years or so now, something like that. I really only made my first what I would call value investment probably in about December 2018, I would say, so a little over a year ago now. And that's just too short a time frame to give you a reasonable answer. What I can tell you is that all the research supports that a value investing strategy applied well can work very well over time. Any investing strategy applied poorly can work very poorly over time. There's periods where value investing will work very well and other times where it won't, but largely over the long term, I don't think you can go wrong with buying high quality assets when they are trading for less than they're worth. That fundamentally just makes a whole bunch of sense to me, but I'll have to let you know once we're kind of a few more years down the track. If you don't want to put in the work, I mean, not financial advice, of course, but indexing, it's hard to go wrong over the long term. Many people will tell you that. So and as far as putting in the work, it's something I enjoy. Like I don't see it as work necessarily. I like learning about business, learning about investing, digging into companies. It's almost like a treasure hunt. It's kind of like fishing. You put in a whole bunch of work and you hope you catch a big one. It's a little bit like that with investing. So you're constantly kind of hunting through opportunities, and when you find one that makes a lot of sense, it is very exciting. So thank you for your question, Sam. Andrew, where do you go for comments on NZ companies that are a bit more substantial than simply Wall Street's auto-generated creation? So for the most part, I don't really care what any analysts have to say. I like to make my own calls on what I think about a company, whether it's New Zealand based or otherwise. As far as information, like I think it's honestly pretty hard to beat the good old Google alert. So if there's companies in New Zealand that I'm following, I'll literally just set up like a Google alert to email me weekly about top stories and all things, different things that are going on with them. If I really want to dig into a company deeply, I'm just going in and reading the annual report and looking through financial statements and management commentary and all those sorts of things. So I don't really have any fancy tools for you, unfortunately. That's sort of the way I approach it. I basically set up Google Alerts for anything that I want to follow really closely. I also have a couple of generic kind of Google Alerts set up, like 52-week low, like a 52-week low search for the ASX and NZX, and then there's several US companies that I get weekly kind of updates on that often I just skim through because it's a lot of the same stuff all the time, and it's a lot of, again, these Simply Wall Street articles saying, oh my god, this company has a low PE ratio, is it a good investment? Stuff like that, which really doesn't add much value. So that's kind of the way I approach it. So thanks for your question, Andrew. And that is actually the last question of today's Q&A. So hope you enjoyed the video. Drop any questions that you might have for the next Q&A down in the comments below. I'd love to hear from you so we can keep making these videos. If you did enjoy it, hit like, hit subscribe, and I will see you in the next one. Cheers.